heard on Tuesday, because what you heard is an absolutely perfect example of a quantitative strategy. And the first lesson is nobody ever does purely quantitative strategies. The purest form of that is, of course, what Ken French puts on his website. And that's, of course, very difficult to execute. And all of a sudden, you are in the world of doing compromises, bringing other information to bear. Now, some of it, and a lot of the qualitative stuff that they talked about, can in fact be quantified. Answers to a yes-no question, is there too much leverage here or not, are actually quantitative answers, and you can build them into a model, and if you can find the data for earlier years, you can backtest them. But what you saw was that inevitably there is a temptation to say, I can do more here. And there's both a temptation that's fairly straightforward that you saw from the presentation last time, and there is a temptation that's much more subtle. The temptation that's more straightforward is what you heard. Are there off-balance sheet liabilities here? You can't go back and backtest that. You've got to do that going forward. But what was the critical thing that Artie and these other people did in doing that? Anybody, and this is what I hope you remember, you better track the performance of those decisions. Now, there is something also that they did, I don't know if it was apparent, but when you rank order opportunities, if the way you decide to impose your judgment in a this, not that format means just moving down from number 50 to number 54, the difference isn't going to be large. They're going to tend to be similarly cheap opportunities, and the chances are you're not going to be doing a lot of damage. If you're moving down from number 50 to number 80 or number 100, right away, you better keep track of what you're doing. So you should have this as a model in mind and think about the overlay you're going to do. Now, the subtle form of this is, when you've got a model, what's the temptation to do all the time? It's to improve that model. Get creative about new variables. Get creative about other things. Now, the speaker that we had who did this, which is probably the most successful quantitative value shop, which until 2008 managed, I think, $700 billion, is Sanford Bernstein. Now, I listened to Sanford Bernstein for 13 years, and they always had 4 variables in their model. The first was a cheap variable, which actually they had a short-term earnings forecast. They imposed regression to the mean on earnings and growth. They did a discounted cash flow estimate, and they compared it to the price. It's like very close to price over earnings. It's just that they attenuate the short-term earnings differences. That's the first variable, and that was the most important. The second is actually a momentum variable, and momentum really matters. You saw that when Tano talked to you about it. And they use that mostly for time interest. The third variable is one that people here actually asked about, which is that you don't want to wind up with 35% of your portfolio in medical insurers. So what they did is a variance-covariance matrix, and if they had too many stocks like this in the portfolio, the excess return that they wanted, the degree of cheap, got higher. And they built a portfolio so that they took account of the incremental risk that this stock added to the portfolio. And the fourth variable changed every year they came. It was everybody's latest good idea. Now, the impact of doing all that was that from 1971, where they started, they outperformed the market by 3%. That put them in the top 0.1% of all investors over that period. If they had used a simple market-to-book model on the same universe of stocks, they would have outperformed by 3.9%. The value of all those clever fourth variables, which lasted a year each, was about -1%. So when you do a quant model, you have to be aware of how these qualitative judgments are going to sneak in. My advice to you is it's better to do it explicitly, the way Summit does it, and track what happens, than to every year improve the model with the latest hot variable, and then over time have to justify why these good ideas are subtracting from what the simple models can do. That is one extreme. What you're going to hear actually next week is the other extreme of a very concentrated portfolio where you really look for bargains and you really understand what you're getting. Now, we are this time extremely lucky to offer something that we really did not offer in the basic class. And that is Mitch Jewis, who's going to speak today, is not only one of the most successful, but most intelligent and reflective fixed income investors out there. Now, he will do a better job probably than me of talking about fixed income and actually multi-asset investments, because you will have noticed, I hope, that so far this has been an equity class. The things I think beyond what Mitch has to say that you ought to remember about fixed income is a fixed income return is capped. You get your interest and your dividend and your capital back, and you know what that is. You don't have to worry about the upside. So in some sense, it's an easier process because you really don't have to worry about whether Amazon is going to grow at 7 or 10% because you're not going to see any of that. What you have to worry about, and this is a consequence of what we described, since the upside is capped, what is your downside? And that's where you're going to focus. Now, a big part of that downside is going to come if the company gets in trouble. So if it has a debt load that's going to get it into bankruptcy or financial distress, you have to think very carefully about the likelihood that that's going to happen and then the cost to you, depending on where you are in the capital structure, of that happening. And that's quite a separate discipline, and we are extremely fortunate to have Mitch explicate it. He is writing a book, and it is going to be the best book on multi-asset investing you'll ever read. When it is likely to arrive, God knows, and I mean that literally.
It's true.
So, thank you, Mitch.
You're very welcome. So, I'm going to try to focus on some of the things that we're actually doing at Canyon in the fixed income area. You can ask me questions along the way, so we can make this interactive. You have general questions about Canyon, how we evolved, it's the fair game. And then also try to bring in some general concepts about what we do that particularly touches on the fixed income arena. But let me back up a little bit, okay? One of the reasons that Canyon evolved into a multi-asset manager was because originally what I did at Drexel during the 80s was totally focused on distressed securities. I was a bankruptcy lawyer. I have a JD MBA. I was a bankruptcy lawyer briefly at Wachtell Lipton, and then I went out to the West Coast to join Mike Milken's high yield group. That was November of '83. And at the time, they were just really taking off in the development of the new issue high yield market. And the distressed area, which typically had involved investment grade companies that had fallen on hard times, fallen angels, those investments that Drexel made under Michael's direction were less of a focus. So if you get to do $1 billion for MCI, which was an unprecedented size in the high yield market, MCI was an alternative carrier to AT&T back then, that is more lucrative, arguably, than buying $50 million of some fallen angel. And so when I arrived there in November of '83, they did $400 million for MGM, and they did $1 billion for MCI. And that's where the high yield bond department evolved and shifted its focus to new issues in the high yield arena, less on the distressed area. And so when I came to their doorstep, which was by virtue of the fact that I had interviewed somebody for an article I was writing for the Los Angeles magazine about how you can make money even in the worst of times. This was the summer of 1982, and I had written an article for Los Angeles magazine about how entertainers use bankruptcy creatively. And they asked me to write another piece about 5 financial strategies during the worst of times, and one of them was junk bonds. Called up somebody from Drexel's high yield bond department because they happened to be mentioned in Barron's. I was editing the article, the first article in Los Angeles, and it turned out that Milken's high yield bond department was right next door in Century City. They said, "Come on over, you can interview us." And then after I interviewed them, they said, "We want to interview you." And a year later, I found my way to their doorstep. Now, the reason they hired me was because by shifting into the high yield issuance area, they were going to spend less time on fallen angels and distressed securities. And they wanted somebody with a legal background who also knew finance that could do these very research-intensive situations and direct Drexel's capital and the partners' capital, Milken, his brother, all the other guys, into lucrative investments. So that's what I did. So I basically, as they evolved the high yield bond market, I evolved the group that focused on their traditional money-making business. And of course, there was a feedback effect, right? Because as they issued more high yield bonds, you don't get something for nothing. Some of those companies went into hard times and had to reorganize themselves. So their issuance eventually fed back into my jurisdiction at different points in time during the 6 years that I was there. And but think about this. If you're interested in money management, think about the balance sheet that I had when I was investing in distressed securities. So that's a very crucial issue because when you think about the discipline of fixed income investing, you have to think about things like your balance sheet as an investor, not just the balance sheet of the company that you're going to invest in. So my balance sheet at the time was, the left side was very concentrated investments in distressed situations, bank debt, unsecured debt, things like Wheeling Pittsburgh, first mortgage bonds. We did a number of the rig companies like Redding and Bates. We did a number of oil companies that fell in hard times during the 80s. So those were very lumpy situations. Maybe I had, at any point in time, I had 10 investments going. And the right side of my balance sheet was the capital that either Drexel gave me or the partner's capital. So I didn't have to worry about what a hedge fund manager typically has to worry about, which is the generic hedge fund guy, his balance sheet is what he's investing in, whether it's equities or distressed securities. That's the left side of his balance sheet. On the right side of his balance sheet is his partnership capital, right? Now, most hedge funds have contractual agreements that say a domestic investor can take out his money with a, let's say, 90 days notice every year, let's say the end of December. And a foreign investor, an offshore investor, can take out his money quarterly. So what does that mean? If I had that balance sheet back in the 80s, I'd have to worry about the linkage between the duration of my investments in distressed securities, which usually at that time resembled zero coupon type bonds of 2 to 3 years duration. That is, they didn't really generate much cash. And at the end of the bankruptcy, I would get a package of, let's say, cash, new securities, maybe equity. So that would be my payoff profile. Very little cash. The liquidity of distressed securities came and went during the 80s as the market developed. Well, because I had Drexel's capital and the partner's capital, I didn't have to worry about redemptions, right? But if I had a hedge fund guy's capital, I'd have to always worry about the match between my assets, what I invested in, and my liabilities were. So the time they were going to take away or redeem the capital I had from Drexel was the day they were going to fire me, essentially, for bad performance. But until then, I didn't have to worry about redemptions. So think about that, how when we set up Canyon and we formed our first hedge fund in November of 93, which is 10 years almost to the date that I had first joined Drexel. So my balance sheet was distressed securities on the left side and generic hedge fund type capital on the right side. And that, in this case, 1 year redemption privileges. And then as we developed in 95 an offshore vehicle, it became quarterly. And so very quickly, it became very clear to me that I had to take the underlying qualities of what distressed investing represented and apply it to a broader asset class, which of securities, so that I would have the diversity in terms of duration, event payoffs, contractual payoffs of cash, that would allow me to meet any redemptions that my investors might put to the fund. And it turns out that as a distressed investor, there are a number of things you can invest. You can take a lot of those skills and concepts outside of distressed investing and apply it to spin off equities. You can apply it to recapitalizations that are short of a bankruptcy, where a company does an exchange offer, where a company takes advantage of the opening of the capital markets and takes short duration debt and then redeems it ahead of time and then issues longer duration debt. So all these things are what we call a Canyon total return value investing situations. And what we mean by total return is something that Mark Twain said in the 19th century, very prescient of him, but is attributed to Will Rogers, which is during what happened during the Depression. He says these days, as what Will Rogers he said during the Depression, these days I'm more interested in the return of my money than the return on my money. So again, that was supposed to originally come from Mark Twain, which shows you that the markets go through cycles no matter what century you're in. And I think the Rogoff book, this time is different, goes through 8 centuries, which says there really isn't, it's not that different. You know, economies have a tendency to go through exponential growth, so it leads to an overshoot, and then they either collapse to some extent or they go through some period of oscillation, which sometimes is referred to as volatility. So total return value investing, which is the return of your money as well as the return on your money, that means that when you look at any sort of security, particularly particularly fixed income securities, you're going to be looking at your entitlement to cash from your contractual rights under a bond or a loan, or an event such as a refinancing, or let's say an exchange offer where you get a package of new securities. So you're not just totally depending on the market saying that, this credit is a better credit than we originally thought, so the spread tightens because the discount rate applied to the contractual rights you have under a bond is lower, so therefore the price of the bond goes up. That is typically what is thought of in terms of bond investing from a capital gain standpoint, but it's certainly the coupon that you get that is also part of your return, or the amortization on a loan. So it's the return of your money as well as the return on your money. So guess what that allows you to do? When you have a total return approach to value investing across a variety of asset classes, the original issue of balance sheet congruence, which goes to whether a hedge fund manager has flexibility and resiliency, all the issues that come up these days when you look at companies. You're not just thinking about earnings and growth rates and whether you're earning a return on capital in excess of your cost of capital and your moat and all that stuff that you've learned in much better form and more organized. I'm not going to be able to do that stuff that Professor Greenwald does. But the idea of the company's overall staying power and resiliency is key to a hedge fund manager or any other money manager, just like it's key to many companies, especially these days. So when I am a total return value investor, now my left side of my balance sheet is constantly generating cash as well, and so I have different sources of return. I have cash, I have potentially capital gain recognition in the market for the market saying, hey, now that an event has occurred or now that we have faith in this company, we think this bond is worth more than it was before because we think those cash payments are less risky, therefore the discount rate is lower, therefore the price goes up. So you get cash, you get capital gain, and so as a result, you get a nice duration match with your liabilities, that is your obligations to your investors. And that's key. A lot of hedge fund managers forgot that they have to manage their balance sheets as well as have a good investment philosophy and strategy. So as a result, some hedge fund managers, and we've never really done this, incurred financial leverage to generate higher returns on top of the leverage that was inherent in the nature of their obligations to their investors, which is if they want to get their money, they can get their money. So now they've made the right side of the balance sheet potentially more rewarding to what they generate on the left side of the balance sheet, but it's also more risky. They've undermined their staying power. In addition to leveraging up with financial leverage, the right side of the balance sheet, the left side of their balance sheet evolved into private equity investments as well as the typical things that some people thought the hedge fund manager was investing in, which was essentially public securities of different kinds. So think about it. A person puts in money in a hedge fund. He has quarterly redemption rights. And turns out, after Lehman, the left side of the guy's balance sheet is 40% invested in private equity, which has a duration of, let's say, 4 years, a payoff, no cash in between because it's leveraged equity in and of itself. So there's no cash flow. And the possibility of an event is now, instead of, let's say, 3 or 4 years, maybe it's 5, 6 years. And illiquidity is rampant for that kind of security and the kind of environment we had in 2008, last quarter 2008. And the rest of them are different types of investments. So the other 60% could be distressed securities, total return, investments in performing securities. And then the other side of his balance sheet, he's got these increasingly nervous investors who have redemption privileges. And he's also got margin loans that supposedly go out a year or more with the investment banks, but they're getting under their own pressures, and they're starting to mark to market the value and saying, hey, no, you got to post more collateral, you got a lot more cash. And all of a sudden, the liquidity of hedge fund managers' balance sheet gets squeezed just like a company that you may be looking at. And so he loses his resiliency, his staying power. And it is those times that some hedge funds have to sell things at the wrong time because they have to meet maturities that came due sooner than they thought on their financial obligations and also redemption obligations to investors. And you know, Warren Buffett, is he going to speak this year again? But he has spoken to this class in the past. So Warren Buffett understood this problem from the beginning. At least, I don't know him personally, but I think he understood this problem from the beginning. He ran an investment partnership, and he had a great investment philosophy and strategy, which you've been reading about and studying and applying, right? Value investing approach. But as he entered the 70s, I think he understood that structure determines behavior. That is, his ability to perform his strategy, his philosophy, was a function of his structure, and he didn't have a great structure. If he was going to make big investments, even if it's in liquid equities, or if he was going to be able to do special situations, which he also does, as you've seen it throughout his history, having a partnership set up where people could redeem, let's say every year, I don't know what his exact structure was, is not necessarily the best structure. So he basically said, okay, hey guys, I have this entity, Berkshire Hathaway, it's a public company, you can exchange your partnership interest into share interests if you want, or I'm going to give you cash, and guess what? Now that structure gives him all the staying power that he may need, because subject to what he has to deal with as an insurance company. I mean, I'm not saying it's as easy as all that, but all of a sudden his LPs, his limited partners, can sell to each other or into the market as opposed to putting it to him. So he doesn't have to worry about his investors. And as Berkshire Hathaway morphed into from a textile company into an insurance company, what was the inherent leverage, financial leverage that he had? Long duration, sticky obligations to people who had insurance contracts. So he had best of both worlds. He had a situation where nobody could redeem his equity, and he had long duration liabilities to people who also had sticky types of obligations. So the only constituency he had to satisfy, which we all took notice of this in 2008, was the credit default market, CDS, credit default securities, and the rating agencies. That was the only thing that came close to upsetting this almost impregnable structure for investing the way he wanted to invest. And why was that? Because he had sold puts on the S&P, and everybody was marking everything to market at the end of 2008, right? So people started taking notice. His credit default spreads, insurance spreads started widening from 100, well, let's say less than 100, whatever it was, to, I think it reached 550, right? The rating agency downgraded him from AAA, and it became a reinforcing feedback loop with negative consequences to him. But he's Warren Buffett. The structure was, he had a lot less leverage than all the other guys out there, Goldman, et cetera, and he had better liabilities given those insurance contracts. So once the federal government came in and sort of socialized risk, everything worked out And but that was why, to some extent, you saw Warren Buffett become somewhat alarmist about the state of affairs and called what we faced post-Lehman Pearl Harbor. He was looking for the cavalry to come in to make sure that even his structure could not be attacked post-Lehman. And so he did two things. One is essentially call in for help, which the government gave to everybody. And secondly, he basically did what I think you saw David Tepper boast about, which I think is somewhat misplaced, which is follow the footsteps of the government in making, actually anticipate where the government was going to plug the holes and invest accordingly. So if the government was going to put money into Goldman Sachs, he would make an investment that was better than the government's investment in Goldman Sachs, et cetera, et cetera. Okay, so fixed income skills and concepts. First, apply at home. When I was growing up, we used to watch the Three Stooges all the time, and Officer Joe Bolton said, never do this at home. Never do what the Three Stooges did at home, which is hit each other and poke each other's eyes out. But guess what? Most guys who invest in fixed income don't take those skills and apply them to home. That's where you should be applying them. Manage your balance sheet. Know what your assets and liabilities are. Make sure you have staying power and flexibility at all times. Because if you do, that means that when others have to sell things at the wrong time, you get to put money to work and earn returns that a fixed income investor could boast about versus a value investor with a lot less variables, arguably, to worry about, like growth and competitive advantage period and all the things that you've been learning about. So staying power, balance sheet congruence, all those things are key issues from the fixed income side that you first have to apply to the structure of what you're investing in, of the structure that you have to house your investments as well as to what you're investing in. Okay. I hope that's pretty clear. Anybody have any questions about that? Okay. So let's talk about the idea of return of money as well as return on money and dig a little deeper. We have to, as background for that idea, let me just talk about a few slides that we've used at Canyon. The credit crisis. We started seeing the credit crisis show itself in the subprime mortgage market. That's the first part of this slide. And it came to a head in 2007. We started buying credit default insurance on the BBB minus layer of the subprime mortgage vehicles I think it was the latter half of 2006, and we put it on between 150 and 250 basis points. That means that for paying, let's say, over 5 years, either 150 or 200, either a point and a half or 2.5 points off of the face amount of what you're being insured for, if the BBB minus layer of a structure, so think of it this way, again, the balance sheet. The left side of the balance sheet is subprime mortgages. The right side of the balance sheet are all these different tranches of debt that the rating agencies have said this is let's say the AA tranche, the A tranche, the BBB minus tranche. If it looks like the quality of the left side of the balance sheet starts to deteriorate, and there's a lot of defaults, you get to be paid par on the credit default insurance. And the way that's marked to market is if people think that the recovery from that layer of the securitized vehicle is, let's say, 80 cents, so they'll pay more than 150 to 250 basis points to protect against the deterioration of, let's say, the price of that tranche. Let's say it's at par. They think there's a chance that it can go to 80. So as the chance of it going down to 80 cents on the dollar, because people start seeing all these defaults on the subprime mortgage, goes up, they start to pay more for that security, and the spread starts to widen out. So they quote it in terms of spread widening. You saw that with Buffett, originally less than 100 basis points, moves out to 550. Similarly, the stuff that we had moved out from 150 to 250, then to 400 to 500, then it's to 1,000, then once it goes beyond 1,000, it starts quoted in cents on the dollar, like in bond terms. So, whereas before you get, let's say you get paid 5 points up front or 10 points up front to take, somebody will pay you to take on that risk. If a guy has exposure in subprime tranche, he'll say, well, things look a lot dicier, let me pay 10 points for insurance now. So, or 20 points for insurance, or 30 points, or 40, or 50 points, depending upon what his view is. And all of a sudden it starts to cascade.
Can I say this a little more simply?
Yeah.
Suppose you have fire insurance on your house. What the fire insurance on your house pays you is the full value of your house. As the fire gets closer and closer to your neighborhood, and the likelihood that your house is going to burn down and the shell is going to be worth it, you will pay more and more for that insurance. What do you get when you buy a bond and they do a credit default swap on the bond? You get the full face value of the bond, like the full value of your house, if that bond defaults at all. Obviously, the bigger the likelihood of default, the more the insurance premium is going to be, both for the seller and the buyer. So what they did is they bought mortgage bonds that, when they started, nobody thought was going to default. When they finished, people thought they were almost certain to default, which means that the value of the insurance that they owned went way up. Is that helpful? Sorry.
No, that's exactly. We used that as an example because of the fact that credit default insurance existed. Those, as the fire sort of approached the house, the market takes notice and reprices the insurance continuously in the marketplace. And that, it's a benefit, but it's also one of the real curses of securitizing risk, because once a price is put on these things, then it has a feedback effect on those who take in one side or the other in the bet. So that's how Paulson made a lot of money. We got that bet on. We didn't have it as much as he did, but he made a lot of money because he bought the insurance very cheaply on that BBB minus tranche of the subprime vehicles, and they exploded in value because everybody came to realize they weren't as good as people thought.
This house was going to burn down.
Big time. Fire kept going closer, and then you started seeing this house on the block go up in flames. So that was the first inkling that we had. And then, because everybody prices off of everything else, the corporate credit markets, as you see in the slide, also began to deteriorate. And here you can see the spread differences. You had the indice prices. June of 2007 they were here, 99.86, and then July 95, 45 and 88.26, and then down to 72. And you can see it expressed in terms of credit default insurance on Ford and Mirage, how they start to widen. And here you can see what happens on the amount of the deterioration credit standards. Here you start to see what's going on over time in terms of the high yield index starting to be a little more volatile and leveraged loans. And then you start to see what goes on with 3-month LIBOR. Gets down low and then all of a sudden starts to spike up. So these are all indices of things that were going on in the credit markets that were causing people to get worried. Yeah?
Here's the question for what you mentioned before. How is it that the rating agencies haven't gotten into trouble with, it seems that the mortgage insurance was initially priced correctly and then exploded due to a mispricing of the credit risk by the mortgage agencies?
Well, they're in trouble. Whether or not they have lawsuit-type liability, it's not exactly clear. I mean, you can watch the volatility. Was it McGraw-Hill, which owns Moody's, right? So people are making bets on their ultimate liability through that equity. So the game it's not over yet as to whether or not there's any culpability for which the government will assess them or investors themselves will assess them. They would argue we're expressing an opinion just like anybody expresses an opinion. We're not insuring for a result. Right? Okay, so the credit market started to get a little more dicey, and as a consequence, anybody who invested in fixed income had to deal with both the problems associated and the opportunities. So, how do you deal with it? Besides having a good structure that allows you to have staying power, what do you do as a fixed income investor in this environment, whether it's in structured securities or corporate securities? What are the things that you are going to look at? Now, let's focus on corporate securities first, and then I'll go into some of the things that we do in mortgage-backed securities. In corporate securities, you're interested, as I indicated before, in staying power and resiliency, as opposed to growth and return on capital. Now, growth and return on capital, sometimes, let's say growth can be a problem for a company because if it's growing beyond a sustainable growth rate, that means it has to access external financing, and if they take on more debt, then equity, the leverage goes up, and if the debt is a short duration type debt as opposed to long duration debt, the right side of the balance sheet starts to impact the company's ability to engage in its business plan. And so you see that a lot of companies sometimes overinvest because the capital markets are open, debt is tax advantaged, and they overshoot on their leverage. They have over-optimistic notions of what they can achieve with their business. They take on too much leverage because the market equity capitalization seems to justify taking on more leverage. Drexel pioneered the notion that you shouldn't measure debt to the market equity idea instead of debt to book equity, which sometimes works, sometimes doesn't work when you have overly bubble-like conditions. And companies just take on too much debt. So then the question is, can they grow into their balance sheet? Can they sell assets that don't earn them much but generate cash so they can pay down their debt? Can they work with their banks to extend their maturities? All these things are involved, which sort of flies in the face of what Modigliani and Miller provide as a benchmark when you look at capital structures, which is capital structure doesn't matter. Capital structure doesn't matter in the ideal world, but in the real world, where you have taxes, where you have bankruptcy issues, and where you have feedback effects between just like I have to deal with all the time with my investors versus what I invest in, and what Buffett dealt with as he evolved his own balance sheet and structure. Companies constantly deal with feedback issues of whether they've taken on too much or too little debt as market conditions evolve, and whether they can deal with it by growing into their capital structure or selling things or working to extend their maturities or exchanging their debt into equity. Those are all the things that you have to be cognizant of as a fixed income investor. Now, I haven't said much about what is typically thought of as a fixed income investor's toolbox, which is EBITDA to interest ratios, or debt to equity per se. All those things are important, and you can look them all up in the way Moody's and S&P use ratio analysis to analyze companies. What I'm talking about actually has something in common with what Professor Greenwald writes about in the introduction on fixed income securities and security analysis, which is the notion of how a balance sheet evolves through time. That is another key issue. So just as, again, the notion of what your balance sheet is at this point in time, whether there's a congruence between what you have on the left side of your balance sheet and what you have on the right side of your balance sheet, and whether they're congruent at any point in time. On a more dynamic basis, you have to worry about how balance sheets evolve over time. Now, if you read Professor Greenwald's chapter in security analysis, he was talking about the balance sheet evolution of WorldCom. And he was looking at how that balance sheet evolved in terms of what they were growing, what assets they were growing, and how much debt was growing. To give you a notion, and I don't mean to put words in your mouth, but whether there was good earnings quality, and whether you could detect through the balance sheet as opposed to just the income statement, whether the quality of their earnings and what they were doing was kosher or not kosher. Is that correct? Okay. From our standpoint as total return investors across different asset classes, and again, that's a very equity-oriented approach. We look at balance sheet evolution in terms of the things I just mentioned, which is, is the company generating recurring cash flow from operations? Is it accessing the capital markets with short duration or long duration debt? How expensive is that debt? And if the company gets a problem in its business strategy and implementation of that strategy, do they have options embedded in that balance sheet that they can exercise to build flexibility when they need it, so they can hang in there when things get a little rough? So, a good example is a company that survived probably a lot longer than it had a right to, which is Hollywood Entertainment, and which also will give us some insight as to what is going on right now with Blockbuster, which I know is an interesting area for Professor Greenwald, because last year he told me to watch out for Redbox, because they were going to take away all of Blockbuster's business. And we had a guy from Canyon who discounted what he was saying, right? Yeah, and your professor turned out to be a lot brighter than the guy who works for Canyon. So Hollywood Entertainment was the second largest video cassette renter. They grew really quickly during the 90s. They started out financing everything with equity as they grew their store base up to, I think it was 1,800 stores. And they started then looking at the market value of their equity, which was being touted by Montgomery Securities because growth is good. So like Faber College and Animal House, knowledge is good, growth is good. And you guys are too young to forget that movie references. Forget about it. Animal House, it's a fun movie. Rent it. Anyway, growth is good, knowledge is good, whatever. Those are the aphorisms that allow a stock to really get going. People buy into it, it overshoots, and when an equity valuation goes up too much, that's the time that you can take on some nice debt in the high yield market or the bank market, because people start believing in those equity valuations. So that's what Hollywood did. Didn't want to dilute its equity with all this store growth, so started issuing converts, high yield bonds. They took on a bank facility. And And then, that's what you do on the right side of the balance sheet to fuel their basic business, right? Then, when the internet air rage started happening, they said, guess what we're going to do on the left side of the balance sheet? We're going to evolve the left side of the balance sheet from just bricks and mortar to, some form of click strategy. So from bricks to clicks. So they had Real.com. And the metric there was eyeballs, or for some companies, not revenues anymore. For them, it was just the number of video cassettes they sold. It didn't make a difference whether they were making money or not. Just the number of video cassettes sold, because they thought that was the metric that was most important to keeping their stock up. And so they did that while they also had their regular business. And that was a huge cash flow negative for the company. So that meant they had to take on more debt. So their securities started to trade down as we entered around the year 2000. There was a lot of we had the whole tech bust, which I think we started seeing, in April of 2000? March of 2000. So equity valuations across the board started to go down, which means that any company that is looked at from a debt-to-market equity basis, all of a sudden your cushion starts to erode on that basis, and people then start looking at your debt to your book value or your book equity value. People started really paying attention not to the growth, but to actually whether the company was generating cash flow from any of its businesses. And bonds that were trading at par went down to 30 cents on the dollar. Bank debt that was trading at par went down from 100 cents to 70 cents on the dollar, or 65 cents on the dollar. Equity, which was trading in the 20s, I think went down to $1. When people think you're going out of business because you don't have staying power, flexibility, any sort of resiliency, and they start to question your business strategy. Remember, at that time, not only had the tech bubble burst, but we had the introduction of DVDs, a very significant basis. We had sell-through market by Walmart, so that was starting to compete with the renters market. So, just as people get overly optimistic about how to price the risk of the right side of the balance sheet, they become overly pessimistic, arguably, especially with leverage capital structures, on whether the company is going to be able to stay in business. So then you go back to, okay, I know how the company got from being one store, which had more square footage than the average Blockbuster in Seattle, which represented a good idea, to 1,800 stores. I know how they got from there to there. I know how they made the misplaced investment in Real.com, which never generated any cash, which just sold DVDs and video cassettes for less than cost for some crazy reason. I know how they got from here to there. And I know on the left side of the balance sheet, and I also know how they built up all this debt. Now the question is, what are their options? What is their flexibility to right-size and evolve the balance sheet so that they can hang in there? And if you can see that story, then you can make a lot of money. You can make equity-like returns for very little, not very little risk, but you can make equity-like returns, not betting on growth, not betting on a competitive advantage, but just simply the idea that the company is going to hang in there for 5 to 6 more years, let's say. Okay, so what did Hollywood Entertainment have? They gave them that ability to evolve their balance sheet. So let's look at what they had on the left side. Which business is a clear generator of cash, first of all? Real.com. Sort of like the opposite of what I said. You take an asset that's not generating cash and you sell it for some money. This is an asset that is hemorrhaging cash. Nobody wants it. You just shut it down. And guess what? Compared to a lot of other types of companies like LTV, other steel companies, the shutdown or exit costs of Real.com were minimal. There were no unions, no pension obligations, nothing. Just shut it down. All of a sudden, cash flow goes up by $150 million. That's a big deal. So that's one option you can exercise. Your option to exit on the left side of your balance sheet. Well, they had another option that they could exercise on the left side of the balance sheet. Their leases. Right? The average life of a video and DVD rental place, the average life of that lease is about 5 to 7 years. So if they had grown up from, let's say, one store to 1,800 stores, if you look at the average life of their lease, let's say it was 3, 4 years, maybe at most, because they went through rapid growth. Those spaces are pretty generic. It's not like it's a special use kind of space. So there's two things you could do. One is you can let your leases on stores that are not doing that well expire, or you can renegotiate with your landlords, and a lot of this can be done out of bankruptcy, which is what they did, to exit from the leases early because you can use the space for some other purpose. So there's a whole bunch of things you could do with those leases. And any retailer is in the same situation. They usually have flexibility, depending upon how special purpose the space is and the duration of the lease, to call their store base in a way that maximizes the value of the portfolio, or at least maximizes your flexibility and staying power under the conditions that you have. So those are two options that they could exercise. One is exit a money-losing business, and the other one was restructure their leases because they were so generic and short-term in nature. What could they do with the right side of the balance sheet? Well, they had banks who were claiming that there were covenant violations because the cash flow was so bad. There were a variety of things. And so the banks could have declared a default and foreclosed on the business. So then what would they have? They'd be in bankruptcy, Chapter 11, and they'd be looking at all the costs associated with Chapter 11, all the advisors and all the other fees, and they get pretty hefty. Or they could simply say, okay, if you restructure those leases and call your portfolio on your basic business, and if you shut down Real.com, show me numbers that I can believe in, that tells me that you can pay my interest on my loan for the next 5 years and amortize down under a new schedule that pushes out some of your obligations, but essentially pays me back in a reasonable period of time. That's a better outcome for everybody. And if you, as an investor, can anticipate that if you sort of stand in the shoes of a bank investor or a bank loan officer, and you could think of those alternatives. Right now I'm standing in this rabbi's shoes because I didn't have boots today, so I am actually standing in his shoes. If you stand in the shoes of the banker, and you look at his best alternatives, and you can anticipate that he is likely to push out the maturity, give a relaxed amortization schedule, in return for which let's say he gets a higher spread to LIBOR. Not only will the bank debt go up from, let's say, 65 to 70 cents in price almost immediately, but the bonds that are trading at 30 cents on the dollar with a 10% coupon can look to, let's say now, 2 to 3 more years of coupon payment, simply because the banks have decided that it's better to work with the company than to declare a default. And so So without any growth, actually you have negative growth, without knowing whether or not the business is going to ultimately deal with sell-through from Walmart, disintermediation by the cable companies with video on demand, which took a lot longer than they said it was going to take, the emergence of Netflix, the emergence of Redbox, some of which were visible at that time, some of which were not visible at that time, it didn't make a difference. If you're buying a bond at 30 cents on the dollar with a 10% coupon, and you can count on 2 more years of coupon payment, because you can anticipate that the banks are going to play ball with the company, then you have an interesting risk-reward proposition. So we have a sort of saying at Canyon that when it comes to balance sheet evolution, you have to try to anticipate how the balance sheet's going to evolve. You should sometimes and lay your bets accordingly, whether it's at the bank debt level or the high-yield bond level or the equity level. And by the way, a leveraged equity is like an option. And how many people here have studied options in this room? Okay, so Black-Scholes would say, all things being equal, if I extend the duration of an option, what should happen? Goes up in price, right? What happened to the equity of Hollywood Entertainment once the market got wind that the banks were going to play ball? It was trading at $1. Where do you think it went? At least 2, right? At least 2. I think it recovered to 3, 4 pretty quickly. Not because I really loved the business, because now there was optionality associated with longer duration. So think about it, where's the better investment if you can actually see how this balance sheet evolves? Buying bank debt at 70 cents a dollar, which let's say was LIBOR plus 200, which was then becomes LIBOR plus 500 with an extended maturity. So let's say you get IRRs of 20%, and maybe the market takes up the bank debt from 70 cents to, let's say, 85 cents, and eventually 90 cents on the dollar, eventually par over time. You got that investment, or you can buy bonds with a 10% coupon at 30 cents on the dollar, and you know what's going to happen with the banks, and that goes from 30 cents to, very shortly, 40 cents, then to 50 cents pretty quickly. And then you can buy equity at $1, and then it goes up because of what the banks are doing to $2, $3. I mean, depends on tolerance for risk, the need for, the profile of your investors, how much you actually can make in terms of putting money to work. It's not the idea of the investment, how much you actually can put to work. We did all 3 at different points in time. Actually, what we did was we bought the bank debt, then we bought some of the bonds. We had shorted the stock, I think, around $3, $4. Failed to cover it. Forgot the notion that if this was to happen, there could be a real whipsaw effect on the equity, but covered at a decent price, but essentially stayed in the bank debt and the bonds. So anyway, the motto that we have is anticipate a deal and then bet accordingly, whether it's the bank debt, the bonds, or the equity. Precipitate deals. Sometimes you can't rely on the market to do the right thing. The bank loan officer to do the right thing, not exercise the default, accelerate, take the company to bankruptcy. Sometimes you have to call up the company or call up the bank and say, hey, listen, I think this is what you should do. You do what they call reverse inquiry, where you act almost like you're the restructuring advisor. Instead of being the loan officer, you are the restructuring advisor. You say, hey, listen, if you do this, it's going to really benefit you on every other part of your capital structure, and then once the bank loans go up, then you might be able to issue some high-yield debt, or you might be able to issue some equity, and you can sequentially heal your balance sheet, which in turn will give you the ability to exercise on your business strategy, whatever it's going to be. And so there's anticipate what's going to go on with the company's balance sheet evolution. There's precipitate deals by suggesting what the company should do or what the creditors should do. And there's simply the participation notion. That is, just simply take selectively whatever is being served up in the markets if it makes sense from the total return point of view. So that's what we did in Hollywood. Now the same story is being played out in Blockbuster. In this case, they've gone through many different evolutions as a company in terms of debt to equity and kinds of securities that they've issued. And right now, they thought they had pushed out their maturities for a few years and bought themselves some breathing room. And it turned out that the competition from Netflix and the likes of Redbox and the miscalculation of the company in terms of how much inventory they position themselves with really put a dent in their cash flow position and undermined the market's confidence that their staying power was 3 to 5 years and they could generate a nice, healthy cash flow by slowly declining the business or at least staying somewhat steady state. That would eventually deleverage over a nice, reasonable pace. So they re-owned the bank debt, the old bank debt. They took it out with this 12.5% deal only about 6 months ago. That deal traded at par or better, and today it trades in the 70s because of what happened in the fourth quarter when it was announced in the marketplace. And they just announced that they hired a restructuring advisor. They're going to pay the coupon on the bonds. The bonds were trading at 20 cents on the dollar. They're going to pay, I think the bonds have, let's say, 9% coupon. They were trading at 20 cents on the dollar. They were probably trading flat, which means without accrued interest. So to buy time to fix, once again, Blockbuster's balance sheet, they're going to pay out 4.5 cents of interest. So if somebody who just bought the bonds at 19, 20 cents on the dollar is going to get, on Monday, 4.5 points. He's going to reduce his investment by more than a quarter. Just so the company doesn't have to deal with the bondholders while they deal the unsecured bondholders so they can deal with the secured lenders and try to figure out something with them. And then eventually work back to the bonds and potentially exchange the bonds into equity and then figure out whether or not that gives them enough flexibility with a revamped business plan to hang in there and deal with competitive pressures. So it's going to be a very interesting story. I'll touch briefly on how you could take this approach to the RMBS, the residential mortgage-backed securities market, and then we'll stop and just take some questions. So the residential mortgage-backed securities market had all different types of ways of packaging home mortgages. So as I told you, the first disturbances in the credit markets occurred with the subprime mortgages that really began to accumulate in, I guess, from 2002 to 2006. And it was built on the notion that Fannie and Freddie should relax their standards, that the government was encouraging both the Clinton and Bush administrations, the idea that people who had less than traditional credit-worthy profiles deserved to get into a home. The risks were not that great because home prices kept going up. And with the magic of securitization and the rating agencies, you can offload those mortgages from lenders' balance sheets into the market worldwide. And there's an argument that the trade surpluses, which had grown during that period of time, which Professor Greenwald talks about in his book, Globalization, had to be all recycled into any sort of fixed income security as long as it had a nice rating agency label on it. So there was a lot of buying, worldwide buying of these securities. That's where it started. But guess what? There are a lot of home mortgages that are steps up from subprime. There's what they call the Alt-A mortgages, and what you call the prime mortgages or conforming mortgages. So let's just talk briefly about the idea of return of money and the return on money with conforming mortgages, where the loan to value ratios are supposedly reasonable, where the credit profile of the homeowner is arguably good in terms of his FICO scores, et cetera, and the idea he has a job and his ability to show the paperwork, and a lot of which are essentially guaranteed by Fannie and Freddie. Okay? So those mortgages are essentially rated, the same rating almost as the U.S. government, because the U.S. government essentially backs Fannie and Freddie, and that implicit guarantee, which became more explicit, allows those securities to be of that nature, very, AAA, AA, whatever. So what Wall Street does with that type of security, again, left side, right side of the balance sheet, they take these conforming mortgages or these prime mortgages and they split up the cash flows. So some people just want a zero coupon bond. That's what they call a principal-only security. So they don't want any of the coupons. They just want the principal payment based on some notion of when those mortgages will pay off. And some people only want the coupon payment, but they only want the floating rate component of that fixed coupon. So what they do is they create what is called a floater, which is a interest-only bond, which floats to LIBOR. So on the other side, they have to create another payment stream against this pool of mortgages, which is called an inverse IO. So let's say the pool of mortgages has a 6.5% coupon, and LIBOR is 100 basis points. So the guy who wants the floating rate component gets 100 basis points, and the guy who is willing to take the other side of the bet gets 6.5 minus whatever LIBOR is. So that's 5.5%. Guess what? Most people, because of the way they're structured, and again, structure determines a lot of behavior you see in the world today. It's not necessarily that people are irrational. People are very institutional-oriented animals. Where you stand depends on where you sit. So whether, some people say it's rationality, some people say it's irrationality. A lot of it is simply where you are in an organization and what its mandate is. And if you have a mandate to invest in things that float for whatever reason, and that's the majority of the world, you're going to want that floating rate component of that prime mortgage pool. So what does that mean? When Wall Street slices and dices that pool, they're left over with a security that nobody wants. And that was what we identified called the inverse interest-only component. And nobody wanted that, for the most part. And we thought, well, in a world where asset prices are going to be under stress, particularly home mortgages, because there was an overshoot on home values, too much issuance, and the government is going to be under a lot of pressure to arguably keep LIBOR floating rates down, that inverse IO could be worth a lot of money without losing a lot of money. To show you how ridiculous it got, because of the illiquidity in the market, that inverse IO was priced at 5 cents on the dollar
LIBOR was approximately 200 basis points. So if the pool was generating 6.5%, the inverse interest-only security was generating 6.5 minus 200. That's 4.5 points. And that was trading at 5 cents in the market. Now, there's a lot of issues like how fast will mortgages prepay, which starts to cut off your stream of payments, whether or not the government can actually keep LIBOR down, which was thrown into question post-Lehman, whether or not how long they'll keep LIBOR down, whether they'll come up with some other policy initiative that will cause more prepayments. There's a whole bunch of stuff. But think of it in terms of the return of your money versus return on your money. I could be totally wrong about where the government is going to go in terms of the home mortgage market. I could be totally wrong about LIBOR, staying down at 25 basis points, which is where it is now. So in other words, I'm collecting right now 6.5 minus 25 basis points is 6.25. So something I bought at 5 cents is earning that less whatever the prepayments on those mortgages are. I can be wrong about a lot of things. But I'm likely to get most of my money back and in a very quick period of time. And the option that I have created on all the positive scenarios of lower prepayments, a more extended period of economic malaise, which means LIBOR stays down low, all these things, less meddling by the government, all these things that can make that security jump to, let's say, 11, 12 cents in the dollar. In terms of price or in terms of what you're getting back over time, is basically a very cheap option based on the notion of return of your money, calculating every month versus the return on your money in terms of how the market prices that. And in addition, going back to my original point about hedge fund managers, regardless of investment philosophy and strategy, having balance sheet congruence and staying power, because we have to evolve our balance sheets in a good way, just as companies do. I now have a bet in my portfolio that is constantly generating cash, which can be used to either deploy when things get bad in the market, or it could be used to redeem our investors when they get nervous. And it's great to have a short duration, high-paying piece of paper to offset some of our more traditional distressed investments in corporate securities, which I said before are usually not paying you money that much, because most of those loans are set to LIBOR, which is the opposite of the bet I have on the inverse IO situation. And when they get into restructurings, if it's a 2-year restructuring, I usually get my payoff at the end rather than during the period of time. So I achieve a good things, good returns, arguably, and balance sheet congruence, which gives me resiliency and staying power during the times when it's most opportune to invest. So I hope with that, if there's any tolerance to stick around a little bit, because I know it's a little bit late. Yeah. You can ask some questions, and that's what fixed income investing means to us at Canyon Partners. Okay? Okay.
You said it was very quickly, but what is the duration on the reverse interest only?
Excuse me?
What is the duration of that
the inverse IO?
IO, yeah.
Well, it depends on a lot of assumptions you make about how quickly those mortgages prepay. And what determines prepayment is a function of the incentives of the homeowner to refinance his mortgage, which is a function of where mortgage rates are and the availability of credit, which is a function also of his loan-to-value ratios, which are right now under stress. And it's also a function of policy initiative. by Fannie and Freddie, because if a home mortgage is in default, the way those structured vehicles are set up, you can kick out the mortgage, and if Fannie or Freddie wants to buy it instead of continuing to guarantee the interest payments. So if they have the balance sheet capacity to spend the cash, then that counts as a prepayment also. So you can have two sources at least of prepayments which affects the duration. One is voluntary prepayments due to refinancings and prepayments that come from Fannie and Freddie on defaulted mortgages. And when the government gave unlimited credit access to Fannie and Freddie at the end of last year, they allowed Fannie and Freddie to announce early in February that any mortgage that was 120 days overdue on interest, they would, in the case of Freddie, immediately pay off in March, which changed the prepayment assumptions in the marketplace and therefore the duration assumptions. And then Fannie, after Freddie, followed suit saying, we're going to do it over a more extended period of time.
But when Canyon looked at these as an asset class,
yeah,
especially relative to what you said about managing your balance sheet.
Yeah. We assume that the market was pricing in 60% prepayment speeds, which meant pretty short duration obligations, and that's not good for an inverse IO in the sense of how long you're going to get those payments. We thought the prepayment speeds were going to be at most 25% of the portfolio per year. Well, go ahead. It'd be nice to know.
What I said was, we don't do discounted cash flows on equities, because it's all out in the future, so we don't do it. All they do is estimate cash flows. So they'll buy a piece of paper like this, and they'll say, under this scenario, this is what we get in 3 months, this is what we get in 6 months, this is what we get in a year and so. And then they'll do it under all sorts of different scenarios. And then they'll rate those scenarios, and they'll see sort of what the worst possibility looks like, and how much of their money they can get back, what the upside looks like. But when he says return of cash, he is talking about literally estimating under all these scenarios what the cash.
Yeah, regardless of asset class.
So he may talk duration. He doesn't care about duration. He cares about what the cash flows are under these scenarios.
That's very fair. I only have to worry about duration because the market worries about duration. And when the market worries about duration, I have to deal with mark-to-market issues on these securities. And that does affect my balance sheet and what I report monthly, which does affect the right side of my balance sheet, which is a function of investor confidence.
He's now doing his sell job.
No, it's not
cash flow estimation for all the securities he owns. He knows for his whole portfolio what his cash flow profile looks like. And he knows for different redemption and other scenarios what you're going to be able to cover.
Listen.
Makes you much more careful as you're acting. I know that.
No, if I'm appearing cavalier, I'm giving the wrong impression. We
different game. Sorry about that.
Look, if you're under the impression that it's easy to estimate what those cash flows are across the entire portfolio, no. I mean, you're always faced with uncertainties that will affect your estimation of how much you're bringing in every month from whatever asset class, whether it's the inverse IOs or corporate distress situations or refinancings. And also, it's not always easy to know what is going to happen in terms of your investor redemption profile. Obviously, if you look at some of the things that have been reported about Canyon as well as other hedge funds, in 2008, we had to what they call designate a good group of our investments because we could not sell them in the marketplace. And as a result, when people put in redemptions, we maxed out the amount of cash we could give them, and then they had an ongoing interest in this pool, along with the ongoing investors, in these designated securities. Those designated securities, for a brief period of time, did not only included some of these less liquid corporate deals, Club E-type deals, or things that just went bad and the liquidity was lost, but also included mortgage-backed securities, both the conforming and the Alt-A that I referred to. And that was because the ability of the sell side to make markets was so compromised until they healed their own balance sheets, plus the policy uncertainty that was floating around between the Bush administration and the Obama administration was so high. For example, at one point, there was a rumor that the U.S. government was willing to come up with a policy that would give anybody who wanted to refinance their mortgage a 4% or 4.25% 30-year mortgage. And obviously that would make prepayment speeds go to 100%, and if I buy something at 5 cents, that's not a good bet, right? Doesn't make a difference. We actually tried to calculate as best as we could what that would do to the balance sheet of the United States government. And what that would mean to the Obama administration in terms of its flexibility itself to pursue all the social engineering policies that they said they wanted to do. And the cost of doing this program was so high, the mismatch between assets and liabilities on the government's balance sheet, and the idea that you were targeting so many resources to such a small group of people and blowing your capability with other policy initiatives meant to us that this was probably not going to happen. But there was a period of time where you had to consider it. And guess what? The consequences to us was, no matter how careful we try to be about how much cash we're going to bring in and how many redemptions we're going to get, it meant that we had to designate 20% of our portfolio into this illiquid basket dealing with mortgage-backed securities. So, hey, listen, it's not easy, especially in these times. I hope I didn't give you the impression it's easy. We had to deal with significant challenges in our own balance sheet evolution. Thanks to Ben Bernanke and Barack Obama, plus some decent positioning, we were able to get through it. The fragility of any hedge fund business, given the structure that we have, is something that almost everybody knows. That's why Warren Buffett got out of the hedge fund business a long time ago. I have that structure. I try to deal with it as best as I can and still earn good returns, and that's what I have to deal with.
Next, take one more question.
Okay. Go ahead.
You mentioned the sort of issue with CDS and when you securitize those risks, some of the issues that happen there in terms of the speed and what happens with that portfolio. Can you expand on that a little bit?
In terms of...
Well, you said when you securitize the CDS risk, there's that spread that accelerates.
All I was trying to say is any time... This goes into the idea of mark-to-market accounting, which also is very interesting in terms of the effect it had on how people were assessing the creditworthiness of financial institutions. Anytime you create an instrument which people can use to assess the creditworthiness of a company, there was a feedback effect on the company, the perceptions of the company and its overall staying power. So things can happen pretty fast. So, for example, somebody asked, about the rating agencies getting sued, right? So just think of it. There's an onslaught against the rating agencies. And we're under a lot of pressure to revise down their ratings because everything that was deemed to be investment grade no longer appeared so at the end of 2008. So when the mark-to-market, as the stock market went down, on Warren Buffett's, the puts that he had sold, started to have a multi-billion-dollar impact. That market indication of the worthiness of that investment fed into his credit default insurance spreads, going from trading off 100 basis points off of governments, risk-free rates, to 400, let's say, and that puts pressure also on the rating agencies to get ahead of the issue. Then you start hearing, well, the rating agencies may take away Warren Buffett's AAA rating because they're being pressured given everything else and the fact that the market is saying that he's no longer a AAA company, and it becomes somewhat self-fulfilling. And then the rumor that they may get a downgrade then takes you from 400 to 550. And then his stock starts going down. And then when his stock starts going down, everybody thinks, well, he ain't going to be around, so therefore they take down the whole stock market, which in turn means that his put contracts become even more out of the money, which then has an impact on his balance sheet. These things can happen. These cycles can happen, and then the government or somebody has to intervene to break this cycle. And that's why Warren Buffett was saying that it was sort of a Pearl Harbor moment, and even though he evolved from a hedge fund into a public company, he had to deal with the way public securities and derivatives give people a way to bet on not only his earnings power, but his staying power. And he has to deal with that, and all companies have to deal with that today. Okay.
Nice to meet you. I was not trying to apply the course of simple either cash flows to evaluate or investments. I was trying to get a sense. I was trying to get a sense of, those reverse IOs, what the duration is, how long the planning thinks that they're going to be.
Yeah, well, we think like we, actually
Sure, because the prepayments.
I usually think it's it's a function of how low LIBOR is. The LIBOR stays low, you're getting paid so much. It doesn't make a difference how low it is.
All right, well, thanks again.
You will walk out.
Here's the reason I was thinking about this last night, and I said to myself, what's that reason? Quantitative strategy, like a high-road strategy, I said, my answer to it, and my answer to you would be because it's very difficult to sell. Because no matter the fact that you would make excess return, if someone asks you to they want you to be managing their money, but telling them that what you're doing is just not exactly what we want to do. It's like we start investing in life because they outsell. I wouldn't traditionally use an investor definition, because there's not, you're not adding environmental or by initial perception value. So, you see, that's where I was saying to myself, well, maybe what's happening is that people aren't implementing, people are trying to get fancy. The truth of the matter is, it's a very simple rules if this is what we do.
But you're telling me you understand. You know, one of my closest friends last week said you guys are and you know, they do all that obviously. I did not
strategy was the best strategy you could just I would have a tough time selling it to you because my feeling would be that it's so simple in its conception and you would feel that there's any value in that created not so actively selected.
There's something about the technology of this is practice that you have. One day, I think we're trying to use Josh is kids who are not using all invest all around the world in privacy, sorting, data needs of people.
Rich! Yeah! Gatekeeper. Rich, take off?
No.
Right here! No, Rich, come on! I'm coming.
So, you know, in that sense, you know, it's not easy. You know, it's not easy between some of these things. You know, these guys, they're thinking about tracking people with a phone, about implementing this high-tech.
Is mine? Oh, it's out of time. Listen, next Thursday.
Yes.
Next Tuesday, I'll throw everybody out. I won't come up to school, so I won't have to say all along. What are you going to around for? Okay,
what you tell me is I can set up implement this by all means. I think you're absolutely right. There are a lot of things in database. Now, the problem is our politicians, the average business you ask, and I think this is quite and there's a lot of times the problem is that I think you are discounting these things. You know, I said just because you say, because I've had this question myself. You know, come up with a Russian story about it. I expected momentum to go away. It hasn't gone away. By the way, momentum was this company. So we had, let's say, 55 years now. That's the data to go away has to go away. Now, if you that trade moments are relative to and you are talking about the government taxing. Look, talking about it is that you may do actually done so you can several times and you purchase that 1 second there you take a and they say, look, the Intel factory is very just like Imperial. I think you understand. But I know it's really
strange, right? Like the biggest one is,
MC.
oh, is MC, yeah.
Yeah.
Finally we can eat.
Yeah.
On display in this game is an awful lot of talented inside bigs that are freshmen. FSA's a freshman. Wassaway right here, he's a slasher at 6'7". Onyeche.
They foul on Shamik Thompson. You see FSA's well-rounded game.
Yeah, this is why Central's better right now. FSA's developed. Not only scoring the ball, but you see him passing it that way. And for a long period of time, Central this season had no interior game. And Vince Rosario checks in for the game. Again, a guy that can make shots.
A little cold lately from the field, but he is a three-point shooter. Speaking of three-point shooters, wide open David Hicks.
How about the setup there by Wissay, the way he drove in and the drive and kick game on time and on target with that pass.
Hicks has been scoring more lately, averaging nearly 10 points per game. LIU's third leading scorer behind Gise and Kyle Johnson. No look from Marquise Deans. Inside to FSA. It's rejected by Onyeche. Daly off the mark. Deans lays it in. Deans is a little like Obi-Wan Dickey, the former power forward here at Central.
Yeah, he does. Undersized forwards have been, even Victor Payne, the assistant coach, in the Howie Dickerman mode of forwards. Undersized, yet determined and excellent rebounder. For the double, hard double. Deans coming to play.
Deans has been solid here early. The junior from West Hempstead, New York. Three-pointer off the mark for Ronnie Tassett.
See, that shooting, Central's got to have guys that make some shots, whether it be Tassett, Joe Seymour comes in, he's got to make some shots. Rosario's got capability, three on the ball, number 3 on the ball right there. They need offense.
Hicks kicking it out to Olasaware, and the southpaw does not get it. Tassett looking to push, 3-on-3. Bailey inside to Marquise Deans.
When you struggle offensively, nice steal by Bailey.
Central playing with a lot of energy here, and the lay-in for Vince Rosario.
You are so right, David. They are digging in. The intensity level is very high. But I was alluding to is Central, because they don't score the ball well in the half court, needs to get transition opportunities and get themselves easy baskets, especially off their defense.
Yeah, Central 9th in the league in scoring, 10th in field goal percentage, so they need those easy buckets. Olasaware, kind of a 1-on-2, rejected from behind by FSA.
The young bigs in this Northeast Conference, wow, FSA. See, 3 blocks already.
The leader, and one. Devin Bailey. Devin Bailey, not much of a scorer, but he is taking it to the rim here in the first half, and Central Connecticut has taken their largest lead in a vital game for them. 15:55 left in the first half.
And here's Bailey right here, setting it up for a quick cross, and then he takes it in, slides by, avoids the charge, and he finishes.
What is your dream? To be a teacher? A success in business? To design robots? To make a difference in your world? Wherever your dream leads, Central Connecticut State University will help you pursue it. Honored as a leadership institution, CCSU offers challenging undergraduate, graduate, and part-time programs.
At CCSU, teaching is our mission. All that we do is aimed at one thing, to help our students start with a dream and finish with a future.
Which way are you heading? There are so many possibilities and so many things to consider. With more than 80 undergraduate degree programs, Long Island University's Brooklyn campus can help point you in the right direction. Specially designed programs will keep you on track. Internships at top companies and organizations will help you get ahead. Financial aid and scholarships will make whichever course of study you choose affordable. The Brooklyn campus of Long Island University.
With you, every step of the way.
Northeast Conference basketball
is brought to you in part by Choice Hotels International, the official hotel partner of the NEC. Visit choiceforcetravel.com. Central Connecticut leading LIU 10-5 in the early going. Dave Popkin and Tim Capstraw with you. And on the sidelines for us tonight is the immortal Paul Dottino.
Thanks, Dave. No snow and ice is going to stop me. And I got to tell you, Central Connecticut State has really never found a replacement for the injured Ken Horton. That was the death blow to them this season. That's why they're on the bubble right now, trying to make the NEC tournament. Horton was their leading scorer and rebounder and an NEC Player of the Year candidate. He had a torn labrum in his hip. It was his left hip right before the start of the season. They wanted to have a quick surgery, but because he had the flu, they had to delay the surgery all the way until December. Well, he had the surgery. It was the exact surgery that the Yankees' Alex Rodriguez had. So I asked Horton earlier tonight as I saw him warming up, did you talk to A-Rod? He said, no, I wasn't brave enough to give A-Rod a call. But the good news is, for the last 2 weeks, Horton has been working out on his own. He's been given clearance to start shooting the basketball. And while he cannot practice, all systems are go. It looks good that he'll be back next season. Back to you.
Good news, Paul. Thanks a lot. Bailey completes the old school three-point play. And Central leading it by 6. Arnold Mayorga in the game for the first time for LIU. He misses inside, but Onyechi has a second chance. That's Mayorga. Michael Colpo, a shooter with the ball now, also in there for the Blackbirds, a sophomore from Pittsfield, Massachusetts. Onyechi inside.
How about that drop step right there? Work middle, then drop step hard. I can't get over how impressive these young inside players are.
Vince Rosario out to Robbie Tasek. Nice J from 15.
It sure was. That was picture perfect way he got to his spot, elevated and drained it, and that's a confident player right now. He had 19 at Wagner on Saturday.
Tim, what Paul was just talking about, Central missing Horton, LIU has had the same thing going on this year. They have Julian Boyd, last year's NEC Rookie of the Year, out for the year with a heart issue. As we say, misses. Rebound by David Simmons, who just checked in for Central. And LIU thought they would have Aremas Midas this year and Lucas Fagiano. They both left to play in Europe.
No, it's a great job. That could have been devastating for the program. Look at the crossover. Devin Bailey going to really work hard defensively right there.
Robbie Tasek is another guy that has come off an injury for Central Connecticut. He had a high ankle sprain, missed 9 games recently, but he's just starting to get back in the flow.
And you can tell by his elevation on that jump shot that he's finally back to 100%. Again, scoring punch is huge for Central. They play hard.
Colpo, no, rebounded by Shamik Thompson, the junior from Milton, Delaware. Got a chancy pass in transition. We saw Central turn the ball over a lot Thursday at Mount St. Mary's, and that's uncharacteristic for them.
Now, that's what they've got to avoid right here. And Howie Jeckerman, his attention to detail is outstanding, and the way he coaches for taking care of the basketball, you're right, huge priority.
Blue Devils shooting it well from the field, and another turnover as Vince Rosario, the sophomore, steps out of bounds.
Well, they're shooting it well from the field because they're taking and making inside shots. They've got 12 points in the paint right now through Central Connecticut, and that is a huge key. Talking to Jim Ferry, Dave, before the game, he was concerned that his team wouldn't match the intensity of Central Connecticut, and he had good reason. Central is fired up right now. They are pumped up and working hard.
Central always plays well in this building. We mentioned LIU hasn't won here since 2001.
See the ball getting out of Wissay's hands. They're trying to trap when they can to discourage the ball, and now Shamik Thompson going to try to deny him. Let's see high screen action.